we've got to talk about you running the Boston Marathon. First of all, congratulations. Yeah. Is this the first time you've run that marathon?
It is not the first time. It is actually my fourth time.
Fourth time.
The most painful time this time.
Why was that?
It's the downhill. This is the thing we underestimate about Boston. It's a fantastic race, but it is primarily downhill, and that is actually punishing on the quads if you are not training in a downhill way. You get carried away with perfect weather, you just go out fast, probably go against all your best instincts, and then you end up with this situation of very sore quads, which makes stairs very challenging.
And it was great weather. But wait, also, folks, if that's not impressive enough, what number marathon is this for you?
This is number 58 for me.
Okay, I'm out.
What?
Drop the mic.
I mean, what are you doing? I mean, you're running away from something? Are you running towards something? What are we doing?
I guess the journey of self-discovery is going on with these marathons, but it is an iconic race. It's absolutely wonderful, but it is a humbling race, a reminder that we can all be humbled.
John, have you done anything 58 times?
Well, I certainly don't run, but no, that's like asking a mountain climber.
Yes,
why?
exactly.
You know, because
it's there.
It's there.
I think it's wonderful. I think it's wonderful. All right, let's talk about people who are running towards or away from private credit. Sort of where do things stand at the moment? Because there's sort of this hullabaloo about the race for redemptions. And where do things stand right now?
It's interesting. And we are in private wealth, obviously. So we are probably the protagonists behind most in terms of the segment that is buying into private credit. And what is really interesting is how this appetite for risk is so different in private credit versus equity markets. In equity markets, it seems no matter the uncertainty, no matter the bad news, no matter the unprecedented geopolitics, investors just want more. They don't want to take the risk of not being exposed. When it comes to private credit, there is a kind of a sell first, ask questions later type of an attitude. There is a wholesale desire to exit this asset class, possibly because there are so many other great alternatives like equities. There's no must-have in private credit. It's new. Perhaps that muscle memory has not been built up. And there is a little bit of muscle memory in a similar instance with real estate 4 years ago with the B-REIT and the sell-off there. So I think investors remember that something can stay locked up, can stay illiquid for a very, very, very long time. And they're just not willing to take that risk when they could be elsewhere making hay, as in the case of equity markets.
Aoifinn, are you surprised with the performance of this market this year, the equity markets, i.e. we sell off 10% and the war begins? That makes sense. But then we rebounded in this V shape to hit new highs, and I still got boats being attacked in the Strait of Hormuz today, and I got oil still at $90 a barrel. Are you surprised that equity markets have bounced back so much?
I am very surprised. And I think we all would have expected with the geopolitical uncertainty and even the Fed uncertainty now and the fact that inflation isn't where we want it to be, that the consumer continues to be so resilient. Yeah. But is it the consumer that's resilient or the investor that's resilient? That would be a question. I think those are not the same cohort necessarily. And we have, as I mentioned, the sense of FOMO, the sense of where else would you be? You certainly don't want to be in private credit, maybe with the uncertainty there. You don't want to be in fixed income. And real estate itself is looking questionable. So you have to be in equities. You have to keep pace with inflation. You have to generate a positive real return. And in a way, the AI story is really the counter story to all of this uncertainty. That seems to certainly be moving upwards. So in that case, you just want to be exposed.
Is the market just too euphoric right now? I mean, I understand a lot of the fundamentals are working, mainly earnings, right, which are coming in many cases, much better than expected, and even forward guidance from most companies is looking pretty good. But is this market just too enthusiastic?
I'd say yes and no, in the sense that they're probably too enthusiastic when it comes to the large tech stocks. Where they are overlooking opportunities seems to be in the middle area, the mid-cap side. That is the side that has been touted as being the kind of the sleeping giant of AI integration, because once these mid-cap companies start to unlock productivity gains with AI, and remember, they will be late arrivals. They will not be first movers because they don't have the resources to do that. They will have to recruit consultants, maybe investment banks. They will need assistance in doing that. That's the great unlock. These are the kind of pedestrian bread and butter that maybe there is opportunity. So I say not a lot of recognition of that yet.
You mentioned the Federal Reserve. Let's assume we get a Fed chair at some point. I don't know when that's going to happen, but how do you think about the Fed? Because the market's not really pricing in any help from the Fed this year.
No, interestingly, which is probably a positive thing, because if anything, there is risk to the downside, given this call for regime change. That's not something that generally is welcomed when investors are just getting used to a Fed that is fairly predictable in sense of telegraphing its intentions. They've really got used to parsing every word that the current chairman uses. And they've got used to the no surprises doctrine. And I think regime change seems to herald potential surprise.